Hello, welcome back. A subscriber of the channel asked to take a look at a company that many people may not have been looking at lately. That's Nokia. And the company has been down 20% from its 1 year high. If we take a look at the max chart that we have here, you will see that it has had its ups and downs, almost acting like as if it's a cyclical company in some situations. But okay, let's see what the company is doing lately and whether it's an interesting purchase. We're going to examine the 1 year chart here just to see what's going on. You will see that we had a low over here in 453 that was back in March 7. And right now it's sitting at 5.14. So it may be an interesting opportunity. Let's see. So the P ratio of the company is sitting at 16. It used to be much higher. So it's generally speaking at around 16 for a long time now. And the price to free cash flow ratio is positive and low. That's something that I obviously love to see. Outstanding shares a lot, but not increasing for the most part. So that's another good thing. So it has a 10.9, like 11 years of last year's free cash flow to pay all the total liabilities. So they do have a little bit of an extra in terms of total liabilities here, but it's worth examining later and see whether that can be an issue. The 5 year revenue growth, minus 9%, pretty big company, but not increasing their revenues. I mean, they're not massive, but it looks like they are going up and down a little bit. Overall, decreasing in the last 5 years. Not great to see. The net income growth here has been positive, but look at this. It used to be negative minus 1.7, and this is why when it turned positive, it's up quite a lot. 5 year free cash flow growth 61%, and 5 year total equity growth at 2%, slightly increased. It used to go down for a while and then increased massively in 2021. Now, what's going on here? Actually, let me examine. I wanted to quickly take a look. So in 2021, did they actually buy shares? I guess not too many. Back over here. Okay. So, the debt to equity ratio here is 1.3. It's a little bit elevated, but probably not very concerning. I'm assuming we'll see. But the current ratio of the company is sitting at 1.62, meaning that they can easily fulfill their current liability, um, actually they have more current assets than current liabilities, so they can easily fulfill their current obligations for the most part. A little bit low in terms of net income margin, and the returns are fine or okay. They are not great or anything, they are just okay. And yeah, the debt to equity ratio is 1.3, but the company is making, it looks like they're making positive free cash flow, which could be just fine in terms of the debt to equity ratio. This is why I'm probably not too concerned about this. And yeah, not paying any dividends here, as we are seeing a price to book ratio, which I generally speaking don't really pay that much attention to unless we're talking about like financial companies, companies of that sort, like insurance maybe. But okay, let's take a little bit of a closer look and see what the company's financial statements are here. I'm curious because the company had 27, 28 billion back in 2017, and now they're having 25. They have suppressed revenues, and this is something that I typically do not like to see. Now, that doesn't mean that the company is not a buy for sure, because a good pile of cash and a good pile of free cash flow can be just fine, even as the revenue of the company goes up and down. And so we can have a steady company that's making a little bit less and a little bit more every year and still makes good amounts of free cash flow, increasing their balance sheet. In this case, this is a company that I want to pay special attention to what they're doing in their balance sheet, though. So I'm going down and I'm seeing that the net income of the company again has been a little bit up and down. 2020 has been a bad year for them, it looks like, but back to profitability in 2021. Now let's take a look at the balance sheet here, because again we are talking about a company that needs to be increasing its assets here. I want to see that, at least if we're talking about suppressed revenues here. Now the total equity 19.4 to 19.8, so basically the same. That's concerning. I don't like to see that. I'd love them to increase their free cash flow and increase their total equity eventually, because when I'm seeing a company that has decreasing revenues and pretty much the same equity that they had 5 years ago, what am I gonna be buying here? They don't seem to be increasing their equity. They don't seem to be increasing their bottom line. So what are they increasing is the question. So the cash from operating activities is increasing a little bit from what it was 5 years ago. It has had its ups and downs. It's doing better lately. That's a good thing to see. Lots of depreciation and amortization going on. And cash from investing activities is in the negative. The company is purchasing some investments for the most part. And about financing, the company is also paying back some debt. That's pretty good to see. Now, you look at the cash pile. They used to have cash at the end of the period of 2017, 8.8 billion, and now they have 7.6. This is what I don't like here. I'm fine with a company losing cash, potentially losing some of their assets, but they need to be massively increasing their bottom line if to compensate for that, or if they are basically steady in terms of their net income, they need to be increasing their cash, or they need to be increasing their assets. There has to be something that gets better with time, because otherwise, again, what am I investing in? It's gonna be stale for a while if we're looking at the same thing every year. And so, yeah, the cash flow is increasing here. At least that's a good thing. It is affected a lot by the stock-based compensation, of course, but it used to be the case in the previous years as well. So that may be just fine. Yeah, it's a little bit of a curious case here, because we're having a company that is not having great years. They're not really increasing their revenue, yet they do still make some interesting free cash flow. But yeah, their balance sheet looks stale. Looks as if it remains the same every year again. They did have some down years. That's what caused it. But I'm not seeing much progress, is my concern. Let's take a look at the stock evaluation tool. The company's revenue growth, look at this, the 5-year average has been negative actually. So yeah, this is kind of a company that's more or less staying at the same place where it is every year. So let's go, where should we go, like 0, 1 and 2 maybe, makes some sense. Net income margin here of, yeah, again, this is very, very suppressed, 5, 6 and 7. And the free cash flow margin, this has been net income negative, free cash flow negative. This is why it's positive. It's practically speaking negative. And 127 is this year where they had both positive net income and free cash flow. So I guess going something like 90, 100 and 110. And an annual return of 13%, what I typically need to be making at least for me to hold a single stock. Let's hit calculate. And yeah, we're looking at what I would expect here. The company is probably, even at this price, not a go for me. I'm worried about their revenue growth. I'm worried about their margins as well. And even though it looks cheap on the surface, based on what we're seeing here on the chart, for example, and how far down it has gone, it's going down and down. And it's been sort of like trending in a little bit of a range. I'd say that this is not for me right now. It would have to be much lower for me to consider this one. Probably even near half what it is right now for me to consider adding a little bit of Nokia to my portfolio, based on what I'm saying. But let me know what you think about the company. Are you thinking of potentially adding it to your portfolio? Do you think it's overpriced? Would you wait for a come down? Let me know. And if you're not a subscriber, remember to subscribe. Tomorrow I'm opening up the tool for subscribers and viewers. I'll let you know how to get access if you're around. So yeah, if you subscribe, that will help. You will get a notification. And remember to like the video as well, because that really, really helps the channel. And thank you for this. And thank you for being around. And have an awesome, awesome day. Bye-bye.